What is GDP? GDP stands for Gross Domestic Product. It is a monetary measure of the market value of all the final goods and services produced in a specific time period. GDP can be determined in the following ways: production approach, income approach, expenditure approach. Production approach: it calculates how much value is contributed at each stage of production. It is calculated by the following methods. Estimate the gross value of domestic output out of the many various economic activities. Determine the intermediate consumption, i.e., the cost of material, supplies and services used to produce final goods or services. Deduct intermediate consumption from gross value to obtain the gross value added. Gross value added equals gross value of output, value of intermediate consumption. Value of output equals value of the total sales of goods and services plus value of changes in the inventory. GDP at factor cost plus indirect taxes less subsidies on products equals GDP at producer price. For measuring output of domestic product, economic activities are classified into various sectors. After classifying economic activities, the output of each sector is calculated by any of the following two methods. By multiplying the output of each sector by their respective market price and adding them together. By collecting data on gross sales and inventories from the records of companies and adding them together. The value of output of all sectors is then added to get the gross value of output at factor cost. Subtracting each sector's intermediate consumption from gross output value gives the GVA, equals GDP, at factor cost. Adding indirect tax minus subsidies to GVA, GDP, at factor cost gives the GVA, GDP, at producer prices. Income approach. The second way of estimating GDP is to use the sum of primary incomes distributed by resident producer units. This method measures GDP by adding incomes that firms pay households for factors of production they hire, wages for labor, interest for capital, rent for land and profits for entrepreneurship. The 5 types of income are 1. Wages, salaries, and supplementary labor income. 2. Corporate profits. 3. Interest and miscellaneous investment income. 4. Farmers' incomes. 5. Income from non-farm unincorporated businesses. These 5 income components sum to net domestic income at factor cost. Total factor income equals employee compensation plus corporate profits plus proprietors' income plus rental income plus net interest. Expenditure approach. The third way to estimate GDP is to calculate the sum of the final uses of goods and services, all uses except intermediate consumption, measured in purchasers' prices. Market goods that are produced are purchased by someone. In the case where a good is produced and unsold, the standard accounting convention is that the producer has bought the good from themselves. Therefore, measuring the total expenditure used to buy things is a way of measuring production. This is known as the expenditure method of calculating GDP. GDP, Y, is the sum of consumption, C, investment, I, government spending, G, and net exports, X, M, Y equals C plus I plus G plus, X minus M. International standards. The international standard for measuring GDP is contained in the book System of National Accounts, 1993, which was prepared by representatives of the International Monetary Fund, European Union, Organization for Economic Cooperation and Development, United Nations and World Bank. The publication is normally referred to